What actually changes financially when you buy an investment property in your personal name versus buying the same property inside an SMSF? If the same property is held inside an SMSF, rental income is normally taxed at 15%. Capital gains could be zero. With the right research, timing, and property selection behind it, we have consistently seen long-term returns in 10 to 15% per year range, especially in the early years of growth. When area is still developing and values tend to rise more aggressively before things eventually slow down. Let's look at the scenario where you don't sell the property. If the property is owned personally, you are sitting somewhere around 39% tax bracket. Personal ownership gives you more cash flow now. SMSF gives you more wealth later. Hey everyone, this is Mishal here. Welcome back to Smart Property Moves by FPW Group. If you're new here, this is where we break down property investing in a way that actually makes sense. We talk about building a portfolio, using equity strategically, structuring finance well, and most importantly, understanding how the numbers play out over 10, 20, and 30 years time frame. And today we are unpacking a comparison that most investors think that they understand, but very few ever see modeled properly. What actually changes financially when you buy an investment property in your personal name versus buying the same property inside an SMSF, right? Now, just a quick note before we jump right into the numbers, this isn't a personal financial or tax advice. I am not acting as your financial planner or an accountant. What we are doing here is walking you through real case scenarios so you can think clearer, understand your options, and make better decisions later with the right professionals guiding you on your journey. If you like real numbers walkthrough like this, please make sure that you hit the like button, subscribe to our channel, Smart Property Moves by FPW Group. It helps us keep producing value-driven content for you. Right now, before we run into projection, I want to be upfront about the assumption and why we are using them. We are using a certain assumption here in this video, so the comparison is fair, realistic, and easy to believe. Now, when clients buy strategically through FPW Group Buyers Agency, with the right research, timing, and property selection behind it, we have consistently seen long-term returns in 10 to 15% per year range, especially in the early years of growth. Okay, but for the comparison purpose, for the purpose of this video, we are keeping it conservative, almost on the cautious side. Okay, now here's what we are working with. We are using 7% annual growth for the first 15 years because property usually moves fastest in the early phase of the market. Okay, when area is still developing and values tend to rise more aggressively before things eventually slow down. Right? Then we reduce growth to 5% annually for the next 10 years because once a suburb matures, the pace of growth usually slows down and prices move in a more steadier rhythm instead of fast jumps that you see early on. Okay, we are keeping the purchase price at $700,000 for the purpose of this video. The starting rent is roughly $28,000 a year, which works out to about $540 a week, and that sits right around 4% rental yield, which is again very normal for an investment grade purchase. We are going to put all of these numbers on the screen so you can follow what I'm talking about. Right now, we are keeping rent growth at 2.5% a year, which lines up with long-term wage growth and inflation over time. And we are holding this property for a full 25 years. So from the age of 40 to age of 65, right? Now, all of these settings are conservative, believable, and something you can actually track in the real world, right? So let's assume that you buy the property at $700,000 price point at age 40. You simply hold it for the full 25-year window using 7% growth for 15 years, then 5% for the next 10 years. Okay, that single property compounds to around $3,150,000 by age 65. Now let's look at the rent. Okay, year one rent comes down to $28,000 a year or $540 a week, growing at 2.5% annually. Rent reaches about $52,000 a year, which comes around $1,000 a week in year 25, right? So now you are 65. That one property that you purchased for $700,000 is now roughly 3.15 mil. Okay, generating around $1,000 a week in rent, right? Now the entire result changes depending on one single variable: who owns it, you or SMSF. Okay, now let's talk about rental income in year one. But again, I want to be very clear on how we look at this information so no one misunderstands the numbers. Okay, the rent in year one is around $28,000 a year, which works out to roughly $540 a week, right? Now, in real world, most investors will have a mortgage on this property. You will have interest to pay. You will have running costs, and you'll also have deductions. Okay, so this next part is again not profit. This is simply the difference in how rental income is taxed under each structure. If the property is owned personally, you are sitting somewhere around 39% tax bracket. Okay, then on that $28,000 of rent, your after-tax position is roughly $17,100 in year one after tax, right? Now again, that is before mortgage repayments, interest costs, and outgoing expenses. Okay, those expenses will generally reduce your taxable income further, but for comparison here, we are keeping the rental tax piece clean so you can see ownership versus ownership. If the same property is held inside an SMSF, rental income is normally taxed at 15%, which means the fund retains roughly $23,800 in year one. Okay, and again, this is before loan repayments and expenses. We are essentially isolating the tax. Okay, so takeaway in plain English is this: personally owned gives you more access to money today. SMSF owned property keeps more money inside the fund to compound for later. Now we move to the finish line. Okay, year 25, age 65. The property is now $3,150,000 and total capital gain is around $2,450,000. Now let me take a moment here and walk you through the three different sale outcomes. Okay, if you sell in your personal name, you receive 50% capital gains discount, which means instead of taxing the full $2,045,000, you are taxed on $1,225,000 at around 39% tax. That's roughly $478,000 in CGT, meaning after everything you walk away with roughly $2,670,000. Now, if you sell inside your SMSF while still in accumulation phase, long-term CGT is typically sits at 10%, which means tax payable is roughly around $245,000, leaving the fund about $2,900,000, right? And then there's a third scenario. You sell inside your SMSF while you're in pension mode. And this is what most investors and most people don't actually know. Capital gains could be zero, okay? Meaning the fund could retain the full $3,150,000 with no tax implications, okay? Same assets, same rent, same 25 years, just different ownership. Okay, and the difference can be $480,000 or more. Now, let's look at the scenario where you don't sell the property. You essentially keep it and you live off the rental income. Okay, at age 65, rent is roughly $52,000 a year, around $1,000 a week. If you hold the property personally, the rent is still taxable, which means after tax, your usable income might land around $30,000 to $35,000 per year after tax. If that same property sits inside your SMSF and you are in pension phase or you are in your retirement after the age of 65, rental income may be tax-free, meaning you could draw close to $52,000 a year into retirement. So $700,000 today becomes $3.15 million in 25 years using conservative assumption. Okay, Personal ownership gives you more cash flow now. SMSF gives you more wealth later. Okay, and the difference created purely by structure can be around 480,000 or more over a lifetime. So yeah, if you like breakdowns like this with real numbers, real scenarios, make sure you subscribe to our channel, Smart Property Moves by FPW Group. If you're thinking about buying your first investment property, you're thinking about refinancing, you just want more clarity on which structure might align best with your long-term financial goals, you can book a free consultation with one of our consultants, link in the description. Thanks for watching, and I'll see you in the next one.